All right, so now we've gotten to everyone's favorite part of the chapter, some new ratios. We're going to use these to evaluate how effectively our company manages its assets and mainly looking at receivables and how quickly they're able to collect those. The first ratio is called the acid test ratio or the quick ratio. Now this is similar to the current ratio, but it's more strict or more stringent. So it looks at the ability of the company to pay its current liabilities. But as you can see here, rather than using all of the current assets, we only use these three: cash, short-term investments, and net current receivables. And these three current assets are the most liquid, or the ones that can most quickly be converted to cash. Therefore, by using only these three, we're being more strict, and it's really now telling us whether the entity could pay all of these current liabilities if they become due immediately or in a very short time period. So, as I said, because these could really quickly be converted to cash, if all of these liabilities became due, we're looking at could they be paid. The acid test ratio, like the current ratio, the higher the better, because it's saying that we have enough of these really quickly convertible to cash or already are cash. The more of those we have available to pay these current liabilities. So if it's higher, there's less risk. And we said with the current ratio, if you remember back, we wanted it to be at least 1.0, where we had current assets equal to our current liabilities. And above that meant it was safer. So with the acid test ratio, 1.0 or higher is really safe here as well, because it's saying you have enough cash, short-term investments, and receivables, so items that we could get into or turn into cash very quickly. We have enough of those to pay all of our current liabilities. But it's actually in reality unlikely that all of your current liabilities would become due at once. So for this ratio, even down to 0.7 to 1.0 is still fair. It's not as good as 1, but since all those liabilities, current liabilities, likely won't come due, having something slightly below 1 is still pretty safe or fairly safe in this case. But as always, these are general ideas. Some industries would have different standards just based on the needs in that industry. But in general terms, kind of that 0.7 and above would be safe. Okay, the next ratio we'll look at is accounts receivable turnover. This is similar to inventory turnover, but now we're just talking about AR. So the ratio calculates the number of times on average receivables are collected during the year. So basically, if we sold something and then collected all the AR, then sold some more, collected the AR, sold some more, collected the AR, how many times on average do we do that cycle in a year? To calculate this, we take the net credit sales and divide by average net accounts receivable. So a couple things to point out here. The first is that we use just the credit sales. So if we have cash sales, then that does not run through accounts receivable. We're collecting cash immediately when we make the sale. So for this ratio, using just credit sales, just those ones that were sold on account, is what we need to do. However, you don't always have net credit sales. In real life, this is not something that has to be reported on the financial statements. So if you were doing this ratio, you may not know what the credit sales were. Therefore, if you don't have that information, you would just use net sales. And the net part means that it's after you've deducted your sales returns or any sales returns and allowances. So we talked about that in the inventory chapter. We're also using average net AR. So the net for AR means after you've deducted the allowance for doubtful accounts. So not your full amount, but the amount after that allowance. And just to note, that was the same for this quick ratio. We use the net receivables here as well. So full AR minus the allowance for doubtful accounts equals these net receivables. That is what we would use in both of these ratios. And then just as a reminder to calculate the average, we would take opening net AR plus the ending net AR and divide that by 2. Okay, now what do you think here? Is higher or lower better in this case for the amount of times we're able to collect our AR during the year? Yeah, here higher is better, because obviously the more times that we're able to collect that means that we're doing it more quickly. Okay, like I said with inventory, the turnover, it's good, but for me it makes more sense when we look at those days in inventory that we went through. And we have that same type of ratio when it comes to receivables. So we can look at the days sales in receivables is what this ratio is called. And it's the average amount of time that a receivable is outstanding, which just in easier terms is how many days on average does it take us to collect the AR. So we can calculate this if we've already done the AR turnover that we learned here. We just take 365 days divided by that turnover, and that would give us the number of days sales in AR. Now, what do you think for this one? Higher or lower is better? Yeah, here lower is better, because that means that it's sitting in AR for less time than, or it's taking us less days to collect it. So the lower the better, because every business wants to get its cash as quickly as it can. So lower is better, but to really know how well the business is doing, you would want to compare this number of days that we calculate to the credit terms on the business's accounts receivable. So if you remember back to the inventory chapter, when we sold on account, we had like a 2% discount if it's paid, sorry, I wrote that wrong, 2/15, let's say, and then net 30. So they get a 2% discount if it's paid within 15 days, but overall it's due in 30. So this is what you would compare your days sales in AR to. If you're below, because in this case it says the customers have 30 days to pay. If you're below that when you do your calculation, that's good, because it means your customers are paying more quickly than they're actually required to. If you calculate this out and you're above 30 days, then you would want to look into that and say, well, why are customers paying more slowly, and what can we do to have them pay faster? Because cash is always king. A business wants to collect that money so that they can spend it on other things. So they would look into that and determine how they could get their customers paying more quickly. Okay, so this is the main way, or the easiest way, to calculate days sales in our AR if you already have your AR turnover calculated. So if you did this calculation and you've got that, it's really easy to just say 365 divided by your turnover. If you only have to calculate days sales in receivables, you can also use this second way in order to do that. And this is what's in the textbook, so you may need to do it this way on MyLab. That's why I wanted to show you. So in this second way, it still takes 2 steps to calculate this out. First step, you figure out 1 day's sales. So you take net, and this should say credit, net credit sales, and this would be for the year. And therefore you divide it by 365. So the full year amount divided by 365 gives you on average the amount that's sold per day. Step 2, you then use this amount down here and you take your average net accounts receivable divided by those 1 day sales, and that gets you your days sales in accounts receivable. So we can see here we're using the exact same accounts and values in each of the 2 ways to calculate this. So either way, if you do this 2-step method or you do it by calculating the turnover and then this day sales in AR, you'll get the same amount. It's just whichever way you find easier to do that. Okay, so those are the ratios. You can go ahead and practice E9-14 and just complete A and B. That's looking at the acid ratio and days sales in AR. You could do the other ones if you want, but I'm just going to walk through A and B. And when you're doing B, which is days sales in AR, try it under both methods. So using this 2-step method and then also starting with the AR turnover and then going that way. So try those out, and then I will have the solution video available in the practice section for these.